and I guess, with so many people working from home, etc., that the services will be quite congested. So what we wanted to do is we wanted Mark to do the introduction. So unfortunately, Mark, the computer doesn't allow us to have that. So I'm quickly just going to introduce the topic. I'm going to introduce the people around the table, and then I would just like to give you a brief introduction of about 10 minutes about how we see the world, how we've positioned the portfolios, etc. So firstly, just who am I? My name is Alwyn from Merve, and I'm the Chief Investment Officer here in South Africa on Sanlam Private Wealth. I also have a role to play with our team in the UK, and we work very close with the head of the Global Equity Capability, Peter Fourie. On my right-hand side, and he's not on the camera now, is my colleague, David Lurkey. David is one of our senior analysts, and David has also been really involved with the asset allocation, implementation, and thought process that we have discussed with our Mauritian colleagues. And then, of course, Mark is on the line in Mauritius. Unfortunately, as I said, the technology doesn't allow Mark to be part of the conversation now. And if Mark has got questions, we will get it via WhatsApp here in Cape Town. So to start off, maybe why don't you just start with the latest on the COVID-19 virus. Since the beginning of March, what we've seen is that both the infections and the mortality rate has increased. And as a result of that, we have seen financial markets responding very aggressively to the problem. So from the peak, what we have seen is global equities are probably down about 30%. And of course, it's an average number. In certain cases, we've seen a significant decline. For me, it was very interesting to note how the other asset classes have responded. If you look at US government bonds, initially, in the first part of March, they did what people would normally expect them to do. When you get a sell-off or a move away from risky assets, and risky assets being equities and property predominantly, or commodities, if you like to add, when you get a move away from those assets, you would normally find that the safe haven assets, their prices will go up. And traditionally, government bonds, and particularly US government bonds, has been regarded as a safe asset. And as a result of that, in the first 2 weeks in March, we have seen that those prices have strengthened significantly. However, if you look at the last week or two, exactly the opposite has happened. So you have seen that US government bond yields came back from about 1.2%, and it traded right down to below 60 basis points. And then in the last 2 weeks, it just kicked up back to that 1.2%, which tells me that the market is so panicky, if I may use that word, that they don't even trust the so-called safe haven assets. And in this particular period, we've only seen that the dollar was really the strong asset across all the asset classes in the world. So that is what has happened to the markets. Just one or 2 points that I would like to do in terms of just concluding on the virus. One must just understand that authorities, of course, will respond to the virus. And they normally do one or two things, or both. They introduce measures to mitigate the implication or the impact of the virus. But then secondly, a more aggressive measure is that they will introduce measures that will suppress the ability. Happens, then you must understand that there will be an economic response to the external shock that the economic system had to deal with. And in this morning's discussion, I want you to distinguish between the economic implications and financial market implications. The economic implications, and of course the virus has got human implications. We need to deal with that on a daily basis. But when we think about investments, we've got to focus on how we think financial markets and financial assets will respond to the events and what we should do in portfolios to create something that will benefit client portfolios, what we call through the cycle or on a longer term basis. Okay, so I would just like you to make that distinction. So if I can start with the economic fallout, in the areas where we had the first signs of the coronavirus, of course, was China. And if you extend that in terms of what has happened in Europe and Italy in particular, and now in the US, economic activity will certainly come under severe pressure. And I just want to take you back to 2007, 2008. In 2007, 2008, during the global financial crisis, economic activity on a quarter-on-quarter basis back in 2008 fell, and globally fell to a level of -8%. So you could see the world went into recession. Now, there's no doubt in our minds, if you look at global economic activity, that the economic impact of the virus will certainly be another global economic recession. And in all likelihood, as a result of the suppressing measures, the short-term measures, because for me, if people compare the economic crisis, the current one with 2008, my own view is, or the SPW view is, that the economic crisis was more systemic and therefore potentially more harming from a longer term perspective than the current crisis. Because I just want to take you back to 2008. In 2008, Lehman Brothers, a bank that has been in existence for 154 years, went bankrupt. At that time, there was more than $3 trillion invested in money market funds, essentially in the banking system. And if one bank fails, there was a risk that other banks might fail as well. So the whole banking system was a question, and the risk was that people will actually have a run on the banks, withdraw their money, and literally put it under their mattresses. And that, of course, would stall economic activity for a very long time, because confidence was at the core of the problem. That was the core issue. And that is why I say there were systemic risks. In this case, the economy is not broken. We've had an extended period since 2008, 2009 of 10 years of growing economic activity. What we've seen now as a result of the virus and the suppression measures, that economic activity has come, I won't say to a standstill, but it's been very hard hit. And it is likely to be the case, if you want to argue about it, another quarter, maybe for another 2 quarters. But then and you must understand that I think it's the smaller companies, let's say in the tourist industry, in the entertainment industry, etc., they are not likely to survive this crisis because they don't have strong balance sheets, they don't have big cash balances, and it will lead to economic fallout and bankruptcies, particularly in the smaller cap sector. The other companies that will be at risk are companies that don't have a strong balance sheet. In other words, they don't have the foundation to see themselves through a period of sustained lower economic activity. So that will happen. So we can't argue about that. But once we go through this crisis, economic activity will recover. Might not be in the way that we understand it now. But I'll give you a simple example, and we often debate it in the office. Not everybody agrees with me, but what I say is, and I can only give you a South African example, Mark, you can give me a Mauritian example, or I can give a Namibian example. If Joe's Beer Garden in Namibia, in Windhoek, if they can't see themselves managing themselves through this crisis, they will probably close their doors in 2 months or 3 months' time if they haven't closed it already. But what will happen? Once we've gone through this crisis, tourists will start to travel again. Tourists will start to go to Windhoek again. And if Joe doesn't open his bar and his restaurant again, somebody else will do it. because it is a money-making idea. Human beings are creative people, and they will manage themselves out of the crisis. You can't sit on the pavement. If you're a creative person, you will find something else to do. And the same with the wine industry, the same with the tourist industry. If people haven't bought a car now because they can't get, because the supply chain is broken from China, and they have the money in 2 years' time, they will buy a car again, and economic activity will continue again. But if the banking system is broken, you have a serious issue, because you need to remedy the situation with resources you're not exactly sure would be the correct resources. So short-term economic hardship, no doubt about it. Longer term, I don't think the system is broken, but we don't argue. I don't think we will escape a recession. If you look at the whole year, if you go and look at the IMF numbers, they expected economic growth rate of about 3.2%. I reckon that, as we say, on the front end, and then hopefully we'll see a recovery happening later. So that is the first. So that is the economic kind of background. Now, what about financial markets? I already said to you that financial markets sold off significantly, and it was to some extent indiscriminate. In other words, the entire market fell. But of course, as in a time of crisis, you will find that some shares or some assets will fall more than others. So if you agree with us that at some point in future economic activity will recover, then in future there will still be successful companies. And the one thing that we know is investment returns only come from two areas. The one is the change in the rating. Talk about equities, the price earnings multiple, if you like. It's probably the one that most people use. In other words, what are people prepared to pay for the financial performance of a company or property or even a commodity? That is what we call the rating. So if you have a re-rating, in other words, if the asset is trading at a low price, the next big move must be they are prepared to pay more for the financial performance of the particular asset. And what we've seen is that prices have fallen or derated significantly. Why? Because they simply say the economic performance of these assets are going to come under severe pressure. And of course, that is the right assumption to make. But it all depends on your investment horizon. If you're a trader, you will absolutely do it. If you're a long-term investor and you were cautiously positioned, in other words, you have cash in your portfolios, and that is exactly where we sit. If you have that, then you can say, well, what is the next big move in the rating? And if you're already on ground level, maybe you can go to -1, but they are not much more than -1 in the investment world. At some point, that elevator should go up in terms of the rating. So that is the one part of it. The second part is what people normally do when profits fall or the economic performance of an asset disappears. They extrapolate that over the longer term. And we know that is not true. Economic cycles has been part of the human history if you go back centuries, and it will not change. So we think that once you've dealt with this virus and the economic consequences, economic activity will recover, the macro environment will look better, and companies will continue to make profits in that environment. Might be different companies, because some of the companies we know might not exist. But from a top-down perspective, companies with healthy balance sheets and with a timeless business model are likely to produce better earnings in 2 years' time than what they do now. So that is where you get the double whammy. You get the re-rating and you get the better performance, economic performance from the companies. But that is through the cycle. In the short term, expect pain in terms of in an equity portfolio. Some people didn't like it, but we argued that he struggled to find good companies at decent valuations, and therefore he held cash. With the market falling, suddenly this cash gives him what we call in investment terms optionality. Gives him the option to employ that cash and now buy those same assets at much cheaper valuations. And that is exactly what Peter has been doing. He started to employ the cash cautiously, make sure that the balance sheets are intact, and he started to employ that cash. What we will do from an asset allocation perspective, where we also had significant cash holdings, we will start to increase the equity exposure and then reduce the cash holdings. Is there any need to rush into this market? We don't think so. We think that there shouldn't be any angst related to these actions. So from a top-down perspective, if you compare this bear market, because it is obviously a bear market now, you go back to 2007, 2008, the market went down by about 45%. If you go back to 2001, you talk about US markets, exactly the same story. We're talking 40 plus. We've done 30 and a bit. So if history repeats itself, there's probably another 10% in it. I want to be very clear. If history repeats itself, I'm not saying the market is going to fall by another 10%. But there's one difference for me, Mark, and I think it is very important that intermediaries and your clients should understand it. When we said we were defensively positioned, it was a very cautious approach in the portfolio. Because in this cycle that we've seen to the end of last year, we didn't see financial asset prices going into what we call bubble territory. In other words, absolutely crazy inflated prices. We weren't there. We were only what we call elevated. So it was more expensive than the longer term average. But I'll give you a number if you want to. If you go back to the US market back in 2001, the US market traded at a price earnings multiple of 45 times, which means they were prepared to pay $45 for $1 in earnings. At the end of last year, the US market traded at a multiple of about 17, 18 times. So not even half the valuation. So not a bubble territory, but the long-term average is probably about 15, 16 times. So, maybe it can, but I wouldn't worry too much about it. If it falls to those levels, then we will really be very, very aggressive buyers of equities. So that is equities. In terms of, I don't know, whether you look at commodities, we didn't have any direct commodity exposure in our portfolios. Of course, you might find that, some of the portfolios might have commodity shares in their portfolio. In terms of global property, we thought that the property market was also a bit extended. It has come off now. So at some point, you'll have to look at the property market again. And then finally, maybe on another commodity, gold. For us, it is very difficult to value gold because it's not a normal financial asset. It doesn't provide an income stream. So it's kind of an emotional asset. It normally acts as a protector of capital in the last resort, if you like. In this case, it held up quite steadily. After we've seen the first few cases of the coronavirus, the gold price went up, stabilized, and then came off a bit. Not in a big way, but it came off a bit. The other precious metal that was the one metal that really worried us a bit last year, and even at the beginning of the year, was the whole PGM basket. In other words, the platinum, palladium, rhodium. That basket was really very expensive. Palladium prices in particular, in our view, went into bubble territory, and that, against the background of the crisis, sold off significantly and is now almost in line with our long-term valuations. And then finally, the fixed interest market. And again, here, one has got to be very careful because I normally speak generically. But if you speak about government bonds, be careful. if you speak global government bonds, you might be talking about Greek bonds, and that's not what we're talking about here. Those yields are low. So in the case of Europe, they're still in negative territory. If you buy a 10-year German government bond, in the US, as I said, it went from 1.2% and then went down to 0.6% and now back to about 1.2%. So that is still low. But I think in terms of many of the governments that we know today, they carry a lot of debt. And therefore, at some point, their ability to create money, that ability will come in question at some point in time. And I think that is what the market is worried about. In the case of the US, you've got the reserve currency. Some people might argue that they can print money until the cows come home. But nevertheless, I think the market has shown that even for that price, there is a bit of a limit. So I want to summarize. We were defensively positioned coming into the crisis. We couldn't forecast the crisis, because it was an external shock. And you don't position a portfolio for the odd external shock. You position a portfolio on the balance of probabilities, how you see the world. And we saw the world as a more dangerous place given the extended bull market that we've seen, and we were positioned accordingly. When the market fell, on a relative basis, we were better positioned, but you can understand that the asset values came off significantly. We don't think it is time to panic because we think that the bulk of the sell-off is probably behind us. And if you take a through the cycle view, now is the time where you have the ability to pick good assets and rebuild and increase your exposure to growth assets that will serve your clients well through the cycle. You've got to make very sure that you understand that, because your client will challenge you, because the volatility is not going to stop in the next month or 2 or 3. It might be with us for the next 6 months. And they will test that investment case every single day. Mark, and I want to conclude with this. I've said it many times when I talk to my own colleagues. We've got a particular investment philosophy, and we say price is the most important thing that we base our decisions on. In other words, we want to buy cheap assets and sell expensive. And when we go through the different models of the different shares, the intrinsic value is more often than not much higher than the market value. In other words, there's lots of value there. So intellectually, we can see it. But to get yourself emotionally to buy it on behalf of either yourself or your clients is sometimes a bit difficult, because the emotional or the emotion that is most profound or prevalent today is fear. And in fear, there's no rationality. So you need one extremely fearful investor, and they can just sell assets off because people are quite cautious in their buying. So that is why in your own mind, you've got to make very sure that you understand what we try to do, because we think it is the right thing to do. It has been proven correctly for people who have long-term views. But 6 months even, for a 6-month period, can easily remain volatile. And clients will test you every single day. And it will be a very uncomfortable conversation, particularly after the markets have sold down in the way that they did. So Mark, that is me. I mean, that is how we see it.
Yeah, thank you very much. I've got a question. I don't know if you can hear me. We've had some issues dialing me into the meeting.
I can hear you clearly.
Okay, so just etc. And so that will generally be equity funds and a mix of fixed income funds. What would your advice be to a client at the moment who's seeing a drop of percentage points in their, let's say, in the equity portion of their portfolio? Let's say the multi-strat is holding on, but the fixed income isn't losing as much, but on the equity side they're taking a bloodbath. What would your advice be to them? Because clients, it's hard to sell something to clients that don't panic, and they're seeing those numbers ratchet up in terms of their portfolio decreasing in value. What would be your advice to clients?
Okay, Mark. As I said, I don't think your portfolio has been much. Your portfolios, apart from the fact that they've been invested in funds, they're very, from a top-down perspective or asset allocation perspective, they were very similarly positioned to ours. In other words, they were more on the defensive side. So if you actually look at those portfolios, you would have had more cash in your portfolios compared to some of your other international peers. So it is not a great consolation that you have fallen less, because you've still fallen a lot. So that is the first point to make. So in your portfolios, you should have cash that gives you the optionality. And if we think for our clients, and when I say our clients, remember, although we sit in South Africa, we have many mandates that are purely just offshore mandates. So I'm not even talking from a South African perspective. I'm talking from a global perspective. If we think that those assets are cheap enough for the longer term, the last thing that you should do is that you shouldn't allow the panic of your clients to dictate a decision to sell those assets that are perceived to be risky only because the market value has fallen. The intrinsic value of those companies don't change a lot if that company is going to remain with us for the next 20 or 30 years. We have done an exercise by Andrew Evans, who's one of the analysts that we have in the UK. He's done the work on a company called Intercontinental Hotels. Now, those are Holiday Inns, the Crown Plazas, etc., etc. And about 30% of the hotels are in fact in China. So you can imagine they had to close those hotels. But they've got an exceptionally strong balance sheet. They don't own the hotels. Those are, I don't want to say franchising positions. So what Andrew did is he said, if the earnings fall by 50% in year one, 50% in year two, and then recover in year three the same levels compared to what he had in his models before the crisis. And that is probably not likely to happen, okay? But it can, because the capacity is there, the hotels are there. So if people start to travel again and you've got 10 rooms in your hotel and you on average rented out 8, you are probably going to rent out 8 in 3 years' time again. But nevertheless, so let's assume that. Then the intrinsic value only declines by, I think about, let's make it, he said 8, but let's be conservative. Let's make it 10%. Let's be, conservative. Let's make it 10%. So that is what happens, because you assume that longer term, your cash flows will come through again. And the longer dated out, it adds value to the portfolio. So the last thing that you should do, Mark, is allow clients to run for the hills. Not because you want the business, but it's because it's in their interest. Because clients often think that we just pacify them for the sake of pacifying them. But the finance, the science of finance would dictate that over time, if that business can return to normal, there are less value destroyed in the short term than what you think. Of course, if you buy a business and the thing goes bust because the balance sheet wasn't resilient enough, that is another story. So, Mark, what do you tell your clients? You say, well, with the cash that we have, is we will cautiously start to acquire new businesses. Now, we're not sitting on our hands. We sat on our hands until now. We did nothing until last week. Because I said, if it's a bear market, the big risk in a bear market from a top-down perspective is the market sells off by 10 or 15%, and now you think, okay, I've got to jump in. Not necessary. If you go look at bear markets, as I say, they go, it's 20%, 30%, 40%. But then there's a point where the assets simply just become too cheap, and you've got, in the interest of your client, you've got to use the cash in the portfolio and employ that. So, let's say you were underweight, so you will move closer to neutral, and if the market falls further at some point, the valuation will be so compelling that even though the macro news might be negative, you will go into an overweight position where your weight in those assets, where that weight is more than what you would normally hold, simply because on valuation measures. So that is what you've got to tell your clients. And we've written things about it. Maybe what I can ask Andrew is to revisit his thing, because he wrote it. I was in London working with a London team at the end of Feb. I've asked Andrew to write the piece. He's written it. At that time, we were still making jokes about the coronavirus. We thought it was only a Chinese problem, and now the jokes have dried up, and it is easier to see the dire impact of the virus, particularly on smaller businesses. So I'll ask Andrew to remodel and then see what the intrinsic value is. But nevertheless, it is certainly not 30% less. If it's less, then it's 10 or 15% if you want. Dave, I don't know whether you want to add here, because Dave is a super clever analyst. So this is how a super clever analyst look.
Just in general, I think the key here is to remember that stock markets will quite quickly discount the news. So while the general news and newspapers will probably carry on getting worse for another month or two, the stock market, because it plans in advance of that, the stock market should already have a large proportion of the bad news in it. And what you can expect over the next month or so is that the newspaper news will look a lot worse than the stock market news over the next while. And as Alwyn mentioned, the thought process at the moment really should be to move towards high quality companies that have business models that will survive through the cycle, and more importantly, balance sheets that will survive through the cycle. And at the moment, you're getting an opportunity around about now, potentially even better, to pick up these companies at fantastic prices, which are kind of once in a decade opportunities that can then form the foundation for a fantastic portfolio performance over the next decade, because you've now positioned your portfolio in such a way that you've got high quality businesses that should weather this crisis quite effectively. And then through that, show their quality over time. You'll get the re-rating, you'll get the earnings coming through as well. Don't expect this in 6 months. This is a 2-year process for the earnings to recover, potentially even 3 years. But over the cycle, these earnings should recover, and you should get some fantastic returns from current levels, as long as you deploy the cash that you have judiciously.
Perfect. Thanks, David. Thanks, Alwyn. That's very insightful for us and for our clients and counterparties sitting all over Africa. So I think, from our point of view, what we should do is to pull in the Brains Trust, maybe include sort of Ethan from London at some point as well. But then from time to time have this kind of counterparties that have dialed in, and if you don't mind, we can pop you questions, and perhaps we can respond to the clients if that comes up in the future. So thanks very much.
Most welcome. And yeah, if you have those questions, and remember, it's not only a case of equities. We spoke a lot about equities because that is where the big dollar was the only place to hide. But as they said, and as I tried to say, is that creates opportunities. And it's exactly, we had a long discussion with our UK colleagues last week, and they said, because the sell-off is almost indiscriminate, you can also switch between shares where you can sell one cheap, lower quality share and then buy another cheap, higher quality share. And that is exactly what Peter's process is designed to do. And you will see that in their portfolios as well.
Perfect. Yeah, just for the sake of our clients, Peter is from Sanlam Global High Quality Fund, which a lot of our clients are invested in as well. So just for the sake of identification.
Okay.
Great.
All right, well, yeah, thanks, Alwyn. David, I don't know if you just want to log off. Sadly, I couldn't be there, but you just need to log off. And thanks very much, gentlemen.
Thank you.
Thank you.